Many thanks for staying with us. Of course, this conversation is about the 70% windfall tax on banks. And Kenneth Erikume, partner PwC, joins me for this. Thank you, Kenneth, once again for staying with us.
Thank you. Nice to be here.
Absolutely. Well, the last time we had you on Business Edge, this tax was just 50%, but now it's 70%. What do you make of it? Do you see a reconsideration on the horizon, given the loud, noise against it?
Well, it's gone through both houses, so I do not expect, because it was an executive bill, right? So I do not expect that there'll be any reconsideration. I think that the law will be assented to and banks would need to comply. Of course, that's a big problem because 70% is a lot of money. Can you imagine if you made some income today and someone then approaches you and says, well, you've got to pay 70% over to the government? That's the feeling the banks would be having right now. 30% already, the Nigerian corporate income tax rate is quite high relative to other countries in Africa and globally. So we are a very high corporate tax jurisdiction, because apart from income tax, your company's income tax at 30%, you also pay education tax at 3%. And education tax is not actually on profits, it's on the pre-depreciation profits. And then you have the police trust fund, you have the NITDA levy of 1% of profits before tax, and so on. So already we are a high tax jurisdiction from a corporate tax perspective. So when you now say, apart from all of that, someone wants to then say, give us 70% of your profits, I think it's going to be a lot for the banks to grapple with, especially at this time when they're dealing with the issue of recapitalization. It's just going to distort the valuation of the banks from that perspective, and it's going to be quite complicated.
But we'll come to that. Now, looking at the amendments, the windfall levy will now be applied to, all profits made from foreign exchange transactions from when the new forex policy was implemented until the end of 2025. I mean, I don't know, I'm just asking, doesn't that sound like this is no longer a one-off tax? I mean, why is it extended up till 2025?
Yeah, that's a good question. The lawmakers, in their wisdom, amended it and said it has to extend to 2025, which means it's going to cut across 3 years, actually, 2023, 2024, and 2025. So clearly, from that perspective, it is not a one-off situation. And that raises several questions. Number one question it raises is, is this really addressing the windfall, in quotes, if there is a windfall? And like I said the previous time I was on this show, there is actually no windfall, but I'll come back to that. So, it's going to raise a lot of perception issues and questions, right? In the first instance, over 3 years, that shows some consistency and it shows that it's not one-off. The other question it would raise is whether this is, is this where it's going to stop? Is there going to be other ones in the future? And even other industries need to be wary. If I take the oil and gas sector as an example, we've had instances where the price of crude goes significantly above $100 per barrel. Would the government at those points come up with a windfall tax that would, impose taxes on that industry? So those are some of the questions that it raises, and whether this sort of approach will be consistent from the government going forward. But clearly, it is not one-off for the banks. It is going to be hitting their profits over the course of 3 years.
Well, how does this compare with regulations in, other places, really? Let's see if there is a comparison, if there is, maybe a country we're modeling after with this.
There is There is no country that this is modeled after. So windfall tax is not out of place. It's something that, governments do when people get into unusual profits. So for example, when you had the Russia-Ukraine war, energy prices went up. So consumers had to pay a lot to procure electricity. So the energy companies made a lot of profits from that. So to that end, the government then imposed in many countries a windfall tax. Now, I have not seen an instance across the world where a windfall tax was imposed on exchange gains. Now, let me clarify the principle. In Nigeria, we have a reporting currency, and that's the currency with which you report your financial statements. A company's functional currency could be dollars, but based on Nigerian regulations by the Financial Reporting Council of Nigeria, you have to report your financials in Naira. So if you have a foreign currency asset on your balance sheet and the exchange rate was 750, let's assume you had $100, it means that on your balance sheet, you would have 75,000 Naira. At the end of the year, if it becomes 1,500, it will mean that you close with 150,000 Naira. So that exchange gain between 75,000 Naira and 150,000 Naira, the 75,000 Naira goes into your profit or loss account as income. Now, in reality, on the balance sheet, the $100 has not changed. So there is no real windfall. So what government has effectively done by taxing that transaction is to take 70% from the additional 75,000 Naira the bank has declared as profit, thereby reducing the $100 significantly. So effectively, what you have is not really a tax on income because there's no real windfall, but a tax that erodes the dollar value of the banks at the end of the day. So there is no country, as far as I'm aware, and in the current economic space, there are many countries going through similar situations as Nigeria. In terms of high inflation, in terms of a lot of pressure on the exchange rate. Egypt, Ghana, Venezuela, Argentina, and none of these countries have imposed a windfall tax on exchange gains,
right,
as it relates to reporting in their local currency.
All right. Now, this is coming at a time when the banking sector is actually trying to raise capital. Already, they have been restrained from using their retained capital, and then considering that the debt market is further shrinking with the federal government crowding out the private sector. What do you make of this? Isn't this stifling?
Yes, so it is. I can imagine the chief executive officers of banks scratching their head right now, wondering what the next step will be or how they would deal with all of this. First of all, in recapitalization, you can't use retained earnings, so you've got to go raise the funds from somewhere. Of course, you can do a rights issue to existing shareholders. You can go do mergers and acquisition. You could go do a public offer. What it effectively means is that there'll be erosion of the capital that the banks have built up. And there'll be questions around the valuation. Is the valuation right? They have to go back and redo the model, and the offer to the public has to take into account this windfall tax, because what they would have presented as, the reporting accountants would have presented something and said, this is the outlook of the business. That has to be altered with this windfall tax. And it would obviously infringe on their ability to raise the required capital. So that's on one hand. On the other hand, the banks are heavily regulated. So of course, with the central bank's monetary policy, there are already challenges, right? challenges which the banks are well equipped to cope with and they are coping with. For example, the cash reserve ratio of 45%, they have to deposit that with the central bank. So they can't do anything with that. Of course, they have to deal with the issue of loan to deposit ratio. So for every deposit they get, they have to give out loans. And of course, the one that everyone talks about, which is the monetary policy rate, which is at an all-time high of 26.75%.
And the asymmetric
which
corridor
infringes on their ability to actually give credit. So there'll be a ripple effect of all of these things. The cash which they normally have, to give loans to the real sector and mobilize small and medium enterprises, that will shrink. And they would obviously gravitate to more secure and safe investments at a very uncertain time. So those are some of the impacts that unforeseen impact that this law may have on that sector.
Well, isn't it baffling? I want to speak for shareholders now, because they would have borne the brunt in the event of losses, but then they've been denied direct benefits from forex gains, because of this particular windfall tax on the one hand, and then on the other hand, the government is seeking to appropriate such. Was that the plan all along? What do we say to these shareholders?
Yeah, I guess the age-long controversy around the social contract comes to the fore. One of the things the shareholders will be asking themselves, as you can imagine, is would this windfall tax be used judiciously? And that has always been the question with taxpayers. When they pay their taxes, would the taxes would it be channeled to the right resources, and would it be used for the projects that they've been earmarked for? Now, the government has obviously, and rightly so, because government is not insulated from inflation. They've asked for 6.2 trillion to deal with the issue of infrastructure, and then deal with the issue of the revision, the upward revision of the minimum wage. Obviously, those things cost money, right? But the question the banks will be having is, why am I the only person funding this additional budget? There are other businesses out there and other sectors and individuals, by the way, that hold forex. None of these people have to contribute, just the banks. And on the flip side, the banks will be asking themselves, okay, if we do this contribution, on the flip side, would there be a benefit going to, would there be a relief going to the other people who have made losses? Would they get a windfall tax credit on the other side? So those are some of the questions. The social contract, would the funds be applied to the right things? Secondly, why are we the only people, is this discriminatory? And of course, at the end of the day, is the impact it would have for me in terms of the return on my investment. So those are the things shareholders will be thinking of. And of course, investors will ask themselves, when we invest in a particular sector, when we invest into a country, do we have certainty over our investment? And is there reliability in terms of consistency around the policies of government? So those are some of the things they would have to grapple with.
Right. And I guess another question, definitely adding to what you just said, is would there be another retroactive tax, and all of those? Because there is, it's not clear at the end of the day, because anything could happen tomorrow. Thank you so much, Kenneth Erikume, partner, PwC Nigeria, for your time and your thoughts.
Thank you so much. Enjoy the rest of your day.